Meta is up almost 20% after hours on what I would call pretty okay results. Nothing out of the ordinary here, in my opinion, but that's what we're going to dive into in this video. So smash that like button, subscribe if you're new. You're watching Moor Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help 1,000 people achieve financial independence much sooner. And Meta just released earnings after hours today, and let's dive right into it. So from here, you can see that Meta Platforms closed the day at $175 per share, and as of right now, or at least the recording of this video, the shares are trading at around $210 per share, so close to that 20% increase. So it looks like it will open really high tomorrow morning. So that's very interesting. Now, the question is, why exactly is there so much optimism in the name after the results? And I don't think it's a result of them beating their EPS consensus estimates. So you can see here that on the top line revenue, they actually came under what the street was expecting on their revenue. The street was expecting 28 billion. They're coming in at 27.9. So I guess it could be stated that it's in line. The interesting thing is they beat a lot on the GAAP EPS. So 2.72 over 2.55. Now that's all good and well, but once again, this is just one quarter. But I guess because there was so much pessimism baked into this security, that any sort of sign of good news really pushed up the stock. So I think it's really sort of that momentum change going on here. But you can just see sequentially on their own results that revenue is actually up 7% year over year. So that's good. And then obviously their diluted EPS, it's down less than what people were expecting, down 18%. So I guess that makes sense. And I just want to point out a couple items to you, which I think is the reason why the momentum is shifting on the positive for Facebook. You can see here that the daily active users for their family of apps actually increased 6% year over year. And this is actually good because this is what was concerning investors. Like, is the platform slowing down or even going backwards in terms of daily active users? So it's good to show that during the quarter, we actually got an increase. Now, something interesting that I do want to point out with their results, notice that their ad impressions actually increased by 15% year over year. However, the price per ad declined by 8% year over year. So they're really making up for the fact that the price per ad is declining by showing more impressions. This is something to be cautious of, and let's continue watching this. Now, what I would say is that the overarching revenue growth thesis behind Facebook is that the revenue per impression actually increases over time. What this is showing me is the lower monetization rates on their reels, which is what you see on Instagram and on Facebook. They're just lower monetized ad products. This is something to pay attention to a little bit as the business is shifting. This is not good nor bad news at the moment, but something to pay attention to. This is why I want a huge margin of safety if I'm going to buy shares in Facebook. I'm not getting caught up with the momentum right now with the shares going up. And the other thing that I wanted to point out is that they repurchased $9.4 billion of Class A securities, and they have approximately $29.5 billion available. But look, one line lower, they have approximately $44 billion in cash. So they can buy up all of that share price authorization tomorrow. And now, moving on to some of the CFO commentary, I wanted to point out a couple of things. The first one is that they actually expect their second quarter revenue to be in the range of around 29 to 30 billion. Now, just keep in mind, that's actually lower than the current consensus that the analysts have. They're expecting around 31 billion. So it's important to think about that top line as we go through the rest of the year here. And one good thing of note is that they expect total expenses to be in the range of 87 to 92 billion, as opposed to their 90 to 95 billion that they gave in Q4 for their expectations for the year. So that increased level of profitability is what's going to drive our increase in our EPS forecast, and I've already updated my model for that. And so overall, you can see that what they're forecasting for total revenue for 2022 is largely in line with what I'm seeing. I really do think that they'll come in around 126 billion, which is a 7% increase in revenue year over year. And if you look at the cost side here, you can see that the guidance of 87 billion to 92 billion is baked into my model. You can see that the total cost and expenses is around 90 million. And notice how I've sort of plugged it all into G&A. So you can see G&A just exploding from 2021 to 2022. That was just a simple plug that I did just to get the expenses in there. But notice how I made it even higher for 2023 and beyond. So just a little bit of conservatism in my valuation there. So for the Patreons, download the model and change the inputs as you see fit to get to the valuation that you think is most reasonable. And now when it comes to the valuations, I do want to show you guys something interesting. So you can see here that I've put on the top here that it's an accounting rules situation versus a real life situation. And what do I mean by that? Notice how I have two valuations. I have an EPS valuation and I have an adjusted EPS valuation. So what's driving these two valuations? And really what's happening is they have additional costs that they're pushing through the P&L because the accounting rules state that these particular costs have to get pushed through the P&L in the current year. However, I don't necessarily agree with the accounting rules all the time because some of these costs are loosely associated with revenues that'll come in the future as they're developing their metaverse. And so here's where you enter this gray area of accounting and you can really make adjustments as you seem fit. And so you notice here I put, this is why I got a CPA versus a CFA, because when you go through the CPA program, you really learn in detail what those GAAP items are and what goes into determining how you book particular expenses, especially R&D expenses, either capitalizing them or expensing them through the P&L. And so where I'm sort of settling in on is I think the company's worth somewhere around $300 per share, but it's definitely not worth $283 per share. So that's kind of what I'm trying to get across to you there. So I'm using a little bit of my background here and expertise in sort of determining what should go through the P&L and what probably shouldn't go. I understand that from a GAAP perspective, it should go through, but just from an owner's perspective, not all of these costs relate to revenues that are being generated today. You guys, it's very easy to explain that some of these costs will go into generating revenues with the metaverse later on. However, there's no direct line, so they have to expense it today. But as an owner with a long-term focus on the business, of course, I would assume that they're going to generate some revenues off of the costs that they're putting in today as they develop the code as it relates to the metaverse. So be that as it may, I'm still being relatively conservative. I'm only using a 20 times earnings multiple, and I'm getting a valuation of approximately $300 per share. And so with a valuation of $300 per share, I've already said it before, I don't want to buy this company for anything over $150 per share. You guys may disagree with me, and you guys may say that it'll never come down to $150 per share. You're probably right, and that's okay. I don't need to get every opportunity in the market. I'm very patient. And like you guys know, last year, I was 70% in cash. We'll see what comes down the pipe. Now, before we look at the cash secured puts, I do want to say that you can get access to the model and the cash secured put sort of annualization tool at the Patreon at the $5 a month tier. And like I say all the time, if you join the Patreon and you find that it's not really for you, no problem at all. Message me in the app and say, hey, Tay, it's not for me within the first month, and I'll completely refund your money. In fact, I actually think Patreon just does it automatically, so you don't even have to message me. But moving on, you can see that the January 20, 2023 cash secured puts, you can probably generate a premium of $17 per share. That might decline tomorrow. Who knows? And then looking at the January 19, 2024 cash secured puts, you can probably generate a premium of $25. Okay, so what does that mean? Well, you can see here on the cash secured put tool that for the January 19, 2024, $150 strike price, $25 premium cash secured puts, you can see that although it's giving you a simple put yield of 16.7%, if you annualize it, it's approximately 10%. So for me, that's too low. I generally like to target at least a 15%, usually around 20%. So let's look at what the 2023 cash secured puts yield. And so you can see here that the same thing, $150 strike price, $17 premium, generates a simple put yield of 11.3%. However, on an annualized basis, it's giving you a 15.4% put yield. So it's a good yield, and it gives you relatively good downside. Like, in order for you to lose on this transaction, the share price would have to decline below $133 per share. So that's something to consider. But the real question is, will that $17 per share premium be available tomorrow morning when the shares open? I'm not sure. We'll see what happens. And so overall, it's very nice to see the renewed optimism for Facebook and that the shares are trading up. However, if you haven't seen it yet, Alphabet actually reported earnings yesterday, and I did a full breakdown, which you can get to right here.